in financial accounting, why is deferred revenue considered as a liability? Because let's face it, it has the word revenue in it. Let's dive in and find out. Let's assume we run a cleaning company and our normal financial year end starts January 2024 and finishes on December 2024. We have received money from a customer in November 2024 for cleaning services that will only be performed in February 2025. Now, should we account for the money received in November 2024 as revenue? The answer is no. Money has been received in November 2024. The service will only be performed in February 2025, meaning the money cannot be accounted as revenue in 2024. This is according to the matching principles in accounting. Well, in that case, how will we account for the money received? It will be treated as deferred revenue. Okay, but how do we record the double entry? Okay, for my friends who are accounting enthusiasts, they are probably asking the question, how do we account for the double entry in the financial year ending December 2024? Well, we will debit bank because money has been received, but we will not credit revenue because remember, this cannot be treated as revenue. Instead, we will credit deferred revenue and this amount will appear as a current liability in the statement of financial position.